Welcome to today's Corporate Venturing Insider series. I am so excited to have with us Temple Fennell, co-founder and managing partner at Clean Energy Ventures. Temple, welcome.
Thank you, Nicholas. Good to see you.
Thank you. Thank you again. So maybe Temple, if you could start sharing your journey into venture capital, and you can take as long as you want.
Certainly. Well, yeah, my first exposure to venture capital was really in the 90s. I was an engineer by training, systems engineer, and we patented a technology with a couple other people. It's an internet technology. It was actually for online services and internet back in the 90s, and basically built one company around that. And we launched a second company too. So first one was a online game show platform that was basically able to create fair gameplay across sort of multiple bandwidths, multiple connectivities. Back in the day, people were connecting at a 2400 baud modem with a 286, PC. And how do you create fair gameplay with somebody who's maybe connecting through MIT with a PC simulator and broadband? And we figured out how to do that. And then we also launched an online education company with a couple of really great partners. It was initially CD based, and then we moved it to online. And then we had VCs like New Enterprise Associates, Oak Investment Partners, and really sort of got a really great board members and some solid exposure to VC. And then I and then After that, I actually ended up starting basically a fintech company scraping media rights, mostly film rights, and a project finance fund. And we were putting together structured finance around all sorts of media rights using tax equity, pre-sale rights, offtake agreements. Basically, a typical structured finance. We would sometimes do a multinational tax equity structure between countries like Italy and South Africa, which is sort of an unusual tax equity treaty that they had. And then we'd create another entity in the U.S. and do a sales leaseback system. Pretty complex structures. And more than 20 years ago, I ended up marrying into an oil and gas family. So my wife's family's from Louisiana, Texas, Arkansas, and three public companies. So it's a traditional sort of timber, oil and gas, large scale agriculture family. And we started investing in clean energy and regenerative ag back in 2007. And part of that was, really kind of going deep in the technology. I was fortunate in that one of my not only was terrific family that was very progressive in their thinking about, in 2007, thinking about clean energy investments as a hedge against fossil fuel wars, but also taking a 3,500 acre farm that had been farmed with herbicides and pesticides and fossil fuel not generated nitrogen, and turning it into an all regenerative practice, which is very much sort of on the vanguard, particularly for family offices in that region. And One of the ways we got into clean energy is the CFO of one of my businesses resigned in 1999 to be a wind developer. And just being in touch with him and learning a little bit about the wind space through him, when we actually decided, okay, we want to put a certain amount of capital into this clean energy space. Of course, we looked closely at Coastland Kleiner and NEA and the folks that I knew pretty well. And quite frankly, I didn't quite understand what they were doing. I loved the technologies, I loved the team, but I couldn't understand who was actually going to be the customers of these technologies. Number one, and who was going to actually buy the companies once they were actually built. And from what I could see, their customers had to be utilities. And from my perspective, these technologies would make utilities would help them make their assets more efficient, which is pretty much the last thing a utility wanted to do back then. They got paid to build more assets, not to make existing assets more efficient. Or in oil and gas, back in that time, oil was $120 a barrel. Everybody was spending every dime they could to discover more oil. And even though there were algae farms and biofuels and things like that, other than ethanol, I really just couldn't see how this was a venture play. So given that I had, this friend, who was my CFO who knew a lot about the wind, he proposed an idea of essentially having a long-term view around, acquiring wind rights because the wind development was entirely based on the production tax credit back then, and every time and the PDC was in this cycle of expiration and renewal, and every time it would expire, the wind developers would effectively struggle to raise money, and everybody would write, "Wind is not a viable industry." It had to be subsidized to these PDCs. But we took a contrarian view and said, we don't believe this. We believe the technology and the cost curve is coming down. We believe that it is going to be ultimately viable. At one point, it's not going to be 3 to 5 years. It's probably going to be 10 to 15. So we made a bet with this guy Sandy Reisky and creation of Apex Clean Wind and Greenlight, um, and and that company did very well. But so I really kind of got in the clean energy space through my project finance background, and then we also been investing with Jigger Shaw in a number of investments and met Scott Jacob and sort of became a big part or early part of Generate Capital, and they became a part of our portfolio. So really kind of started much more downstream. But as I got more just my engineering curiosity, it wasn't just enough to understand the financing structure. I really wanted to understand the technology. And as I started to kind of move up the curve into growth equity that we were interested in, and then ultimately, we didn't think that we would have the technical depth of the operating bandwidth to actually manage an early stage clean tech portfolio. One thing that occurred to me as I got deep into it is that you can't really be a growth investor unless you have got very clear and deep understanding of what are the technologies that are being developed upstream. Because these technologies were developing so quickly, you could find a company that you believed had a really strong market position and technology position, but, within 3 years, another technology could be coming out of the lab, that we completely disintermediate, the company and, obsoletize their technologies and their techno-economics, which we've seen time and time again. And then about that time too, about 2010, 11, 12, we also started seeing a number of families like ours that were investing in ag tech and clean tech and even some water tech. And this is after the financial crisis, and some of these, the families were really the primary source of capital for, companies like Tesla and for solar and companies like that. And we came together and we created a syndicate called the CREO Syndicate. CREO stands for Clean Renewable Environment Opportunities. And it was initially about 15 or 20 families from mostly from US and some from Canada. And we came together. We started, comparing, sharing deal flow, comparing, the struggles and challenges that we had in with our portfolios, and really sort of very open. We were primarily investing quite privately in these companies, and that network has actually grown quite a bit. It's now about 230 families, I think, globally, close to a
Wow.
trillion dollars in private wealth. Extremely active investing, probably the most active group in the world. But anyway, so as I was getting sort of more and more interested in the upstream and trying to do ag tech and clean tech, I just realized I thought they were sort of clean tech and ag tech were sort of apples and oranges, and I realized that's not true at all. It's more like apples and Formula One tires, as I say. Well, like wildly different technologies, wildly different customers, wildly different go-to-market strategies, strategic relationships that were required. And so I had to pick one. And with regards to so I picked clean tech, and I realized that the more I knew about clean tech and clean tech technologies, the more I realized I didn't know, and that I really, if I wanted to do this well, and I didn't wanna just be a dilettante, I really needed to go back to school. So I applied to be a fellow at the Sloan School at MIT and came up and just went really deep into the MIT technologies in the ecosystem. It's a great program because you basically they have sort of a rigorous boot camp over the summer, but then you have a full year of carte blanche, at MIT and, Harvard and anywhere you wanna go. And And that was tremendous for me to really kind of really understand, all the different parts of what I was interested in with regards to clean energy technologies, and ultimately really, really became primarily interested in industrial decarbonization. What does it take to take technologies and help these large corporations decarbonize, and which is a big topic in the minds of our operating businesses. We operate thousands of gas stations, offshore drilling, large scale farming, and ended up kept hearing about this group in Cambridge in Boston called the Clean Energy Venture Group. And so I ended up meeting Dan and Dave, became a member of Clean Energy Venture Group, and really kind of got into their portfolio. And at that point, I think I was the 18th member. They started in 2005. This is now 2015. And what was remarkable that I was seeing in this portfolio is they had this incredible low loss ratio. They had only of even though they were doing hard tech, they were doing advanced materials and electronics and hardware. And they was all early stage. They'd only written off about 15% of the portfolio. That was now probably 35-40% of the companies. And so, of course, for me, I was like, how is it that these guys, this is again 2015, Coastal Kleiner, and we know what happened in the clean tech 1.0. But I was curious, was like, how did these guys' portfolio not only survive that time, how did it thrive?
Mm,
And they'd actually taken a number of they had formed a number of SPVs. They had a sort of a portfolio of single purpose vehicles they created that were part of that a number of family offices and investors have come to them and said, "How you guys are so successful, how can we invest alongside you?" So they put together these SPVs, and, when I ran the IRR, it was extraordinary. And they had high DPI, they had high IRR, virtually unheard of. And so I started socializing that with some of the families that were in the CREO network, and also, with people that I knew at Cambridge Associates. And they were like, "Wow, how do we get behind these guys? I mean, this is really a phenomenal track record and really deep team to technical team." So CEVG is really kind of there are 2 types of folks that are in that group. One of that are, engineers and operators like myself that have built and scaled businesses, and the other are people that are coming from the industry. So people that, were senior executives at Siemens or GE or United Technology Corporation. And it was an incredible brain trust and huge tremendous amount of, not only technical experience, but operating experience. And I was like, "This is exactly what the families really need is this early stage team." So I started, telling Cambridge about it as well as their talking about the track record, and also some of the families in the Korea syndicate. And, what came out of that was, looking at this, and at this point, I was back at the family. I took a sabbatical from the family office board, from the investment committee. It's back, working with the family. And, and I worked with Dan and Dave, who were 2 of the founders of CEVG and my partners now, to really kind of structure it was initially gonna be a $50 million fund, and primarily almost exclusively financed by the Korea syndicate families, who wanted to have access to this team, and the team wanted access to the capital. Um, and we went to do a first close. We ended up having about $70 million in commitments. And when LP, said, if you guys would be willing to increase the size of the fund to 100 million, we'd fund 40 up to 40% of that. So at that point, we actually stopped raising capital. I basically resigned from I think I was maybe even at Flagship Pioneering at that point as a full-time consultant. But unwound some of my obligations, because some of the family said, would you be the third partner
mm,
in this fund, CEV, that we launched? And so we opened it back up, blew through the $100 million cap and stopped taking capital at about 110 million. So it was not I had on the VC side, I'd spent most of my life either receiving capital from VCs or providing capital to VCs. I hadn't been a GP until I joined CEV.
Thank you, Temple. I think there is so much to unpack. But I think one golden nugget you mentioned, which I don't need to double click, is ag tech and clean tech are so different. Even in our own investment practice, Tina is driving the clean tech and Ravi is driving the ag tech. It's just so different. You need to really have different convictions.
Yeah.
So, before we talk about your experience of receiving capital or giving capital, I think something that comes across is your curiosity, building from first principles or investing from first principle. I think it all comes from your engineering background. Can you speak to why you think so or not that your engineering background drives you as a better investor?
Boy, yeah, I mean, I would say I have a natural curiosity, as you mentioned, and a bit of sort of dogged persistence and stubbornness. We have a brilliant team, and I would say, most technologies that come across our transom are, first of a kind technologies that or technologies that don't exist in the market. Companies like Macrocycle, it's a chemical recycling company, companies like, Nitrofix, that's basically able to create NH3 molecule, eliminate, el the NH3 molecule out of without using Haber-Bosch. Um, so I don't understand those technologies when they come across. I have to have our chemical engineers, PhDs, and other people to really explain it to me. And I feel like I think the smartest question I can ask is after I've spent as much time as I can studying, and I still don't understand it. I am happy to say to the founder and or my team, just guys, if it doesn't make sense to me, my favorite question is, wait, what? Can you explain that to me again? And honestly, if you're asking a founder, a technical founder who's trying to explain their technology or their business model, and you ask them, "Wait, what?" And they explain it again, and you think hard about it, and you have to ask them more than 3 times, there's something wrong with this. Either they actually don't know what they're talking about, or they don't or they haven't really sort of figured it out or followed through, or they're hiding something from you, which can also be the case. But or, it's just too early, it's still too much in an experimental mode. It's not ready to be commercialized. And importantly, if they can't explain it to me after I've spent my time, really understanding it with the help of my brilliant team, if they can't explain it to me, they're gonna probably have a very hard time convincing other people to give them money. And so they're struggling, they're not able to tell a good story. And that's a key talent, absolutely essential talent, an existential talent for founders to have is to be able to tell a good, simple story.
Yeah, I agree. It's existential talent because it's not just investors, it's the first few team members, it's
Yeah,
going to be the customers, the partners. I mean, you can't
yeah,
tell the story.
yeah.
Yeah.
That's why there's a book actually called Wait What? It's about the 5 most essential questions. It was written by this guy, Jim Ryan. He was the dean of the, education school at Harvard. He's now the president of the University of Virginia, and it's brilliant. It's a question kids have no problem answering, but, uh, but adults typically feel embarrassed to ask.
Eh, yeah, I think there's no naive question.
Yeah,
I mean, there are naive questions, but if you are okay to ask from trying to understand something and you still don't get it, there is something that's going to be problematic and create frictions afterwards. And
yeah,
so now I want to talk about this very non-obvious thing to do, which you did, which is going back to school, despite having been a serial entrepreneur with success, having done successful investments, back to school, and it was a summer camp plus 1 year free range activities. Can you share why you did it? Because I think maybe you're not the only one who would think about it, but was it exactly as you expected, or better, or different?
Oh, it was far better than I ever expected. I didn't fully understand. I'm a big believer in deep work. Of basically when you know there's something you really need to go deep in is to really, clear the decks and really spend time because it's not just studying, it's not reading, it's reflection, it's rumination, it's being free to, go explore places and meet people and be able to connect the dots. And you've got to be free of, the day-to-day board meetings and phone calls and reports and everything else that you're trying to do. And I felt like, I mean, even trying to get, you can get a day or 2 or a few hours and weekends or whatnot, in our normal lives, but this was I really needed to, basically go back to ground zero and say, "Wow, I can learn this stuff by reading, but I don't really kinda understand it. I don't feel it in my bones." And I
Mhm.
felt like as an engineer, I really need to have developed a really an intuitive understanding of what was understandable for me and what I knew and what I didn't know. I mean, and again, I think that's, when you can get to the point where you you're comfortable with what you don't know is almost as important with being confident in what you do know. And I really needed to discover that sort of that fuzzy boundary.
I think being comfortable, even disclosing to your team members what you don't know is so important.
Yeah.
One is if you don't share, then you will be challenged because they don't know that you don't know. But two, it gives a chance for everyone to help you out where you don't know.
Yeah, yeah. Well, a big part of our assessment of, either bringing team members onto our team or CEOs, we talk a lot about what gives you energy, right? And we also then talk about what steals energy from you.
Mm,
And also, what are the things that you feel like you have to do that actually stop you in your tracks and you have a hard time getting started and you're willing to do it, but you don't love doing it. And so when we're building teams, we're very careful to assess, what gives you energy. And that is often that person's superpower, right? They love doing it. And if you can get them to disclose what they're not very good at, which is probably one of the things that's stealing energy from them, you can say, we can find somebody that loves that they get energy from that. So a good example, and I'm sure you guys run into this all the time as well. You have a couple of founders that are very technically based. They maybe, have been in academic situations. And you can see them working together. They don't have meetings, right? They don't even really they write down the basic data, but they're not writing down processes and procedures. They don't probably have a really detailed DOE plan. They're not necessarily following a linear process. They're kind of jumping around and they've got a lot of intuition. Um, and that's tremendous. But when they move from 2 to 20 people, they need to have those processes. They need to have the procedures. They need to have Gantt charts. They need to have project plans. They need to have DOEs. They need to have meetings, right? And some people just are not good at it. That steals energy from them. But so at that point, they say, okay, well, maybe it's better that we bring in a VP of engineering who's basically doing that. And we'll work with you to actually authorize and not undermine that VP of engineering. We may need to actually give you your own little special lab that you can continue to be experimental and you're not involved in production or the final phases of development. Um, and then sometimes these CEOs are quite brilliant. They are able to move from that lab to the place that they're putting together, the organization. We say that, most founders are 80 to 90% focused on the lab, and then they're, and initially they're 100%, and then they're 80 to 90% as they're trying to bring their first investors in. By the time they're at a Series A, that CEO is probably spending maybe 70% of their time focused on internal things. Um, and of that 70%, maybe half or less on the actual technology development. The rest is organizational design and 30% externally focused. And then once they're getting close to a Series B, raising a Series B and they've got revenue, that switches, right? They are 70% externally focused
mm.
with biz dev and fundraising, and 30% internally. And so it's hard for somebody to go from a lab where they're just, focusing on the thing they love, their technology, to basically spending 70% of the time, which can involve, 4, 5, 6 nights a week away from your family on the road, in airplanes, in airports,
Mm.
at meetings. That's a different, very different type of lifestyle. And some people can make that transition and a lot can't. So there's a whole number of things that steal energy from those founding CEOs. And we tend to bring people in at that point to help them.
So I think you just convinced me I'm going to change one or two questions when I interview team members. Because what I mean, I'm going through the Kaufman Fellows program, and one of the big insight was around the zone of genius, which is basically what you just described, which is where do you get energy, where do you get energized, and you're really good at. This is a zone of genius. And this is what you should, as a VC, try to do as much as you can there because you're going to become excellent, build that superpower. But I never ask in the interview, where do you get energy? Where do you lose energy? And if you think about building the diversity of your team the right way, where people can compensate their superpowers and their weakness, that's a question I should be asking. So I'm already going to take an action from this interview.
That's great.
So, but let's talk about this. What do you think is your zone of genius? Something you're really good at that gets you a lot of energy?
Oh, man. I don't know. I'm not gonna use the word genius by any means. Uh, well, I mean, I ended up gravitating to systems engineering and systems dynamics because I really like to put pieces together. When I've done all my the analysis from coaches and whatnot, they says, I'm a sense maker. I tend to bring together a lot of disparate pieces, and connect dots. And I find that I spend a lot of time studying things very, very deeply for a very long time, and eventually the patterns start making sense to me, and I start putting those together. And I'm not great with following. I'm a process guy. I put a lot of processes in place. That's oftentimes too many processes. I'm not a very good process follower. And I have to admit that I do that. I tend to be, I think that if there's anything I do well, it is looking outside of the box, and bringing things in, looking around the corner, looking over the hill, if you will, whatever it may be, and trying to find sort of new solutions and new ideas, and then ultimately put those in practice in some sort of forms of frameworks and processes. And I've done a fair amount of publishing around that, but do not put me in charge of running that process or being the
So
person.
it's interesting. I feel like you're describing you as the right profile for what you were, serial entrepreneur, versus managing a VC firm. So I have to ask, why shift from being the entrepreneur to allocating capital and building a big team?
Well, it's actually I mean, ultimately a company builder. That's what I love doing, and I mean, because we are coming at the seed stage, and I'm the chair of 3 boards and, on 2 to 3 other boards. I just love going in and working with the team. I mean, we have, uh, 2 of our companies right now are really at that inflection of scaling. They've got revenue, they've got purchase orders. We've sort of brought them, through this. And, like, how do we take that to the next phase? Like, what are the
Mm.
strengths? What are the strengths? What gives this CEO energy? What steals energy from them? How do we bring in how do we identify a new CEO? How do we putting a number of processes in place and making introductions? I love that. I mean, I love building businesses. It's probably, the thing that I love most. I liked building a business. I ended up, as I said earlier, I built ended up with my partners building 2 businesses at the same time. I don't necessarily like to do that. That's kind of scary. Uh, but I do like helping other entrepreneurs, raise business and
Yeah,
connecting the
I can
dots.
tell it actually. This is where you're really smiling when you explain it. So this is clearly something where it's not just gaining energy; you just love doing it.
Yeah, I love doing it. And I love building our firm too. And, a big part of building our firm, as I mentioned earlier, our initial investors primarily were family offices, but then also a number of strategic investors came in, even in that first fund, which was, something of a surprise to us because they just love the fact that, we're so deep technically, we're so deep operationally. We get a number of our companies that are brought to us by strategics, by the CVCs saying, guys, we love this technology. We know exactly, we'd love to bring this into our, into our business units. We think these two founders are brilliant. But we don't do a very good job of building businesses. And you guys are purpose built. You've been doing this since 2005. You guys not only built your own businesses, but you've successfully built an entire portfolio of these. So will you guys come in and build? And so having the family, we're so grateful for the support we get from the family office world and also the strategic. But what we really needed to do is get to the institutional world, the pensions, the insurance companies. And they're three very, it's sort of like the apples and the Formula One tires. It's not quite that different, but they're dealing, working with insurance companies, pensions, endowments, sovereign wealth, very, very different than working with strategics and family offices. And it's also, I mean, as you know, raising money is a very much of a relationship-based business. And so part of what I'm doing with my partners is really, coming up with Dan and Dave is, and Ted, our CEO, is phenomenal. Is really thinking about, so, okay, what is the next 10 years look like? What is the career trajectory for these incredible team members we have, so that they're doing what we're doing in 10 years? So I love thinking through that and putting those pieces in place, which it does take, at least 3 to 10 years to actually affect that.
And then you need 10 more years to prove the impact and the value.
Yeah.
Let me shift to, you mentioned strategic. So this is a good time to talk about corporate VCs. You work with them, you invest with them. I think you had mentioned before the podcast that probably 70% of your portfolio are in the cap table. They have a CVC. So, first, what's your view about CVCs? Do you think that most of them are good? Do they bring real value? Is it just talk?
Well, they're all quite different, right? I mean, as you know, and I don't wanna necessarily throw anybody under the bus.
That's
Um,
not a good start of answering.
no, it's not. I mean, I would one of the big challenges I think CVs, I mean, corporates have, and not all of them, but, we see this pretty often, we have in the last 20 years, um, is just, there's a fair amount of attrition, right? I mean, sometimes attrition at the very senior level of the CEO, and nobody likes to inherit somebody else's laundry, right? They don't like the hand-me-downs, and even if the CEO is the same, but you bring a different person in to manage the portfolio, they kinda wanna build their own portfolio. They don't wanna necessarily manage, something that they've inherited. So, there can be a fickleness to CVCs on the cap table, and so which is something, we're aware of, and you have to be sensitive to. Um and so that's can be sort of problematic at times. But not everybody. I mean, some of them, some of the CVCs are remarkably sort of consistent, sort of vintage to vintage. Um, the other thing too is sometimes the new person comes in and they start wanting to not necessarily play fair with everybody. They're feeling like they're the 800-pound gorilla, and this company is beholden to them, and they want asymmetric, information rights, or they want exclusivities, they want other things, and I think one of our roles, and it has been for the last 20 years, is what I say we sometimes play Switzerland between
Mm.
the entrepreneur that's like, oh my God, no, I don't want that corporate to know anything about what we do. They're our competitor, and the competitors are like, no, if we come in, we're gonna, we want to have an unfair advantage, and we have to say, no, guys, rules are. I mean, first of all, work with the entrepreneurs and say, guys, listen, they're not your competitors, they're your partner, and they might be your parent one day. But if you really want to scale this business, there is a lot that you can learn and a lot that you can take advantage of with this corporate. And we tell the corporates, if you want to see it at a table, there are certain rules of engagement um, about about how you can actually have a seat at the table here. Um, so yeah, and they're all different. Now, the really best one, so we've just invested in a plastic company with the owners of Indorama, which is, very, very large recycling company in Europe. They're tremendous. I mean, they're value add in multiple levels, and they've been a really, really great partners. And we feel the same. We've got many. I mean, I don't want to go through all 70, but we've got really terrific partners.
But if you double click on this example, can you share a few of the value adds they bring? Because clearly they would be a potential end customer or supplier. What value have they brought from early stage?
Well, we've been super impressed by, first of all, certainly their technical and operating experience, right? Like working through, because we definitely in our the CEVG group, we have people like John Wisnowski, who was at Exxon Chemical most of his career, and Dr. Malika Gamala, United Technology Corporation, and they can walk in. I mean, a big part of what our model is, even though we're coming into hard tech. We're looking at companies that can basically go from that's what we call pre-commercialization through the early commercialization into proven commercialization where they have customers, they have repeatable, they're out of the pilot phase, they're in the purchase order and offtake agreement phase. We'd like them to make that transition without requiring more than about 30 to $50 million, right? So
Mm.
you're looking at this macro cycle process and you're saying, okay, let's look at each one of the components of this process and see how much is bespoke, where we're going to have to create a custom manufacturing process. Um, can we actually toll manufacture, or do we have to build a pilot plant? If so, what's that pilot plant going to cost? So if everything is bespoke and we have to get to the scale, that could be $100 million build out, right? Stepping down from that, it's like, okay, we have to build a pilot, but we can use off the shelf equipment, and we get that information from the Indorama Group because they know the equipment well from our MVD. Like, okay, that's not going to be 100 million; it might be 20 million. And then we can take it one step further. Can we actually identify a toll manufacturer? And so you need to have the people in the industry that are on the floors of the factories, on the floors of the plants, to really help you with that. You can't just sit there. It's not just a matter of engaging EPCs and consultants necessarily. You have to have the people that are operating this equipment, day to day to really understand that.
I think you've just made a very strong case for one of the best examples. I mean, if you only need 20 million versus 100 million, that's probably accelerated timeline, less fundraising needed. The VCs will have a more capital efficient investment, which should return better. The entrepreneurs are more likely to succeed. I mean, you're making a strong argument that it's capital plus plus. It's the capital they invest, but all the savings that can be brought to that entrepreneur.
Yeah, exactly right. So you're contracting your fundraising time significantly, particularly in environments like this. You're also not, either brownfielding or greenfielding something that's not there. Can you say, oh, it's going to take us a year, and you're 3 years later, you're still trying to tweak it, quality and yield. So yeah, I mean, that's very important for us. Also, so technologies that can be dropped in is super important for us as well. And CEV really having that kind of, being able to deal with the operating guys is like, are you willing to drop this in? What does it take for you to test this before you would actually risk your line to actually drop this in? You've got to have people, with boots on the ground, to be able to do that. Or, when we're looking at something, most everything that we do is highly modular. Like if you look at InCycle is a critical mineral recycling process that can take, black mass from recycled material. And you can say, okay, can we actually basically bolt this onto a Li-Cycle facility or a Redwood facility? Same with Noon. Noon is a long duration energy storage battery. It's highly modular, right? Because if you actually are having to build infrastructure, right, you're having to take up a large footprint somewhere. That's going to extend your time to commercialization as well. And one thing we don't like incumbents to have to retool to adopt our technologies, right?
I was going to ask about this because I've read your what you wrote, and you emphasize capital light models, and sometimes it's very difficult to reconcile infrastructure heavy demands with climate solutions. Can you speak to that a little bit?
Yeah, well, and, honestly, so, um, there's a set of criteria. We feel like, there's a great book, that I know the author one of the authors of. It's called Simple Rules. And you create boundary rules, priority rules, stopping rules. And so we've been very clear since the beginning that we have certain boundary rules. Now, the boundary rules, really it helps focus our team, right? So I'll give you a good example. When we were looking at green hydrogen, first of all, because we'd been in green hydrogen for so long, we were very dismissive of it. It's like it'll never work, right? And then we started seeing more and more technologies. It's like, wow, this actually may work. It's not all about PEM. There's interesting membranes, there's EM. And so, Jeff Weiss, who's our senior venture partner, he basically spent about a year and a half really understanding, okay, what would make green hydrogen investable for us? And he came back and said, well, you need to be able to produce a kilogram of hydrogen for less than 35 kilowatt hours per kilogram. Right. Well, so that's great. So 9 out of 10 deals that are crossing our transom don't fit within that boundary, and our team doesn't have to spend any time on it.
Yep. Very fast decision making.
Is and we kinda did that a little bit with long duration energy storage and why we ended up with Noon, right? It was like, okay, first of all, it does need to be modular. We felt like it, ultimately needs to have a pathway to compete as baseload. So long duration just should not be about resiliency. Um
Mhm.
And so in order to do that, it needs to be basically you need to be able to charge and discharge around 2 to 3 cents a kilowatt hour, right? So if you say renewables, either solar or wind or geo is sort of 2 cents, you need amortized coal is delivering at basically 5 cents a kilowatt hour. So if you really truly want to replace space, you've got to be combined, energy renewables plus storage to be around 5 cents. Also no critical minerals, right? I mean, just, we set a number of boundary rules 3 or 4 years ago about what we would actually look at for LDS systems, and ultimately, we passed on most. Now that, unfortunately, there are a lot of deals that we would love to have gotten into. We could have gotten into Commonwealth Fusion very early, but man, we didn't see we were gonna get our money out in 7 to 10 years.
It's not too late for type 1 energy.
Yeah, no, absolutely.
But I like boundary rules. So that's what we call KPIs in TDK Ventures.
Okay.
So boundary rules is clear. What's the next set of rules?
Well, start of priority rules, right? So you realize you have 5 deals, 10 deals that are all competing, for your attention, and you're having a really hard time. You're we tend to it tends to be sort of a FIFO, first in, first out, for the
Mm.
deals, and it really should not be, right? Because there's suddenly deals show up and it's like, wow, if we're not coming to a quick close because the technology is difficult to ascertain. We're struggling to really get the kind of data we need to run the market. You have to be willing to deprioritize that and reprioritize based on something that's just come in. Um, and so that's really critical, because the whole premise around Simple Rules book is we have limited resources, time and people and money. Um, and you need to be able to constantly reprioritize. The third is stopping, right? I mean, you know how you can just grind and grind away on a deal, and you don't really have a clear idea, like, how to get to a yes or how to get to a no, but it's consuming resources by staying in the queue.
So this one I think is full of golden nuggets. So I mean we struggle with that ourselves. And it's not just for the first investment, it's also for the follow, double down or quit and so on. So what any best practices you can share about the stopping rules, things that you've seen working especially well?
Um, yeah, well, so there's 2 there you identified 2 different places, right, that you need to apply them. One is the initial investment. Um We're one of the things that we're doing is, we're constantly evaluating, our IC, even though it's just me, Dan, and Dave. I mean, the reality is the team is very involved in our process, and, um, I would say, and I don't know, team may disagree with this, but I would say 75 to 80% of the companies, we are all on, in either leaning hard one way or leaning hard the other. There are a few that were sort of split, and that comes to the IC. Um, but if we find we're constantly staying split and there's really not a lot of enthusiasm, and no matter what we're doing, we really cannot get to an enthusiasm because, it's basically what we call limbo. It's in a limbo mode. Um, then we really need to have the discipline to develop a reasons is you know, what we would need to see in order to make the investment, communicate that to the VC and say, we're putting you effectively in a watch mode. And a watch mode means we want to actively stay engaged. Here are the 4 or 5 things that we need to change before we'll make an investment. And frankly, we put macrocycle into a watch mode for a good year and a half, 2 years, and gave them 2 very specific things that they needed to solve for. And they solved for both of them.
So in a way, what you're saying is you have stopping rules and a restarting rule,
Exactly. Yeah.
which is good because then you allocate no resources until what you need to see, which actually is part of your boundary rules, kicks in.
Yeah. Yeah, exactly. And just freeing up, and it's hard because you've got a lot of sunk cost into those deals, right? You got a lot of you have people in the diligence teams that are passionate about it. They may have spent 100 hours, 200 hours or more. And it's a hard thing for them to say, okay, we're not moving forward with that.
It's very hard for anyone first when we talk about sunk cost. On top of that, there is the emotional attachment to the entrepreneur, to the mission, to the project.
Yeah. Yeah, we do a lot, or we try to do a lot to address confirmation bias. And our review process is really set up specifically to try to address that confirmation bias. And that confirmation bias is particularly strong in the second case you were bringing up, which is the follow-on investment.
Mm.
Um, so, I mean, there's sunk capital costs, there's sunk people costs. There's also sunk reputational costs. There's some, many levels. So, to try to not have those overly influence and create a confirmation bias is quite challenging. We're actually looking at a follow-on right now, and we say and we try to approach it as if we hadn't actually invested in the first round, would we invest in this round, right? And basically come at it as a new investment. Um,
It nearly feels like the perfect questions to what will always lead to an imperfect answer.
yes.
Yeah.
Yeah.
I mean, we just started a new process. We just had our reflection week where everyone in the team comes together in San Jose. And we just agreed to a new process for follow on investment where, for first investments, we always have a devil's advocate session where everyone in the team will say why they would not invest. And nothing positive, just why not to invest. We just agreed as a team that when we do follow investment, we will also do a devil's advocate session.
Yeah.
We have yet to see if it works, but at least we are trying to get to the point where we avoid this confirmation bias, this attachment that comes naturally as part of the job.
Yeah. No, I'm very impressed by your devil's advocate process, and we're actually in the process of adapting that as well. I love that. So, my question is, how many times does it change the mind of the team and change the mind, or more importantly, how often does the devil's advocate change the mind of the IC?
First, we do it before the IC. So the statistics I had about a year ago was half of the time it changed the mind of the investment director. And we're talking about the investment director only comes to the devil's advocate when they are convinced this is a right investment to do. So they are at the high conviction. They've already presented to the team before. They've already exchanged, and they went deep into deep exploration, deep into the due diligence. But listening to your peers, to your team members, only saying, so everyone starts with I would not invest because. So no one is allowed to say, oh, I love this entrepreneur, I love this market, but. Because what happens is you latch on the positive, you stop listening to the but.
Yeah.
But if everyone starts with I would not invest because, and they give a number of reasons, even though they might love it, they just don't tell you. It's very, very hard for the investment director not to hear it. And our process goes beyond that, which is the day after they took a night to sleep on it, they have to write down a response, written response to all the points that were made. But at that point, if they want to go ahead, I have no veto right, they can proceed. So it has to be the one person conviction deciding to go ahead. And that is about 50%. But what's not obvious to that 50%, the 50% they decide not to proceed, they will still continue to mature. And at some point, they might come back, a bit like your restarting rule. They might come back saying, actually, the reason I stopped is now fixed. And now I'm coming back, but really eyes wide open.
Right, right. That's great. I like that. You mind if we adopt that?
No, no, no. Actually, I'm hoping everyone adopts it. But what's interesting is it's a simple rule, which is you have to say why you would not invest. And because it's such a simple rule, it's so fair. There's no emotion to it. There's
Right,
no,
right.
oh, you always shoot my ideas. No, this is a rule. Everyone has to do it. And so you know that this time it's you, but next time it will be the other investment director. And I'm trying to explain that when you're challenging an idea, it's a gift. It's something that people want. They want to have all the ideas and then they can make their best decision.
That's great. I love that. That's really good. Another thing that we do, and that this is really good, and I'm gonna definitely want to discuss this internally. Um, Part of our what we call the it's basically the investment review document. We write postmortems, like what pre-postmortems, what went wrong, looking ahead 5 years.
So I think you're talking about premortem, right?
The pre-mortem.
I think premortem is such a good idea. It's tough to do, but it's basically listing everything that could go wrong.
Yeah.
And so for us, we don't do a premortem, but we have a slide which lists all the risks we have identified, which includes some that was missed before but came through the devil's advocate. And we tried as much as possible to say what's the likelihood for each and what would be the severity for each. And I think that the closest we do to a premortem, but I think premortem is such a good discipline because if I think about venture capital, you have to have these two contradicting view in your mind. Everything that can go wrong and what you can mitigate and how big it could get. So it's a kind of pessimist and optimist type at the same time.
Yeah, yeah. No, absolutely. Yeah, and you have to be very careful that you don't let perfect be the enemy of the good. Right.
It's very hard. And so maybe here you can, I mean, you're on the IC, so maybe you can share what it is that you always like to ask when they come to you for an IC decision.
Hmm. Ah, yeah, that's a really can the CEO raise money? I mean, that's a really because typically all the other boxes are checked, and it's a very hard thing to evaluate. Um, and the syndicate, I mean, because the syndicate is indicative of whether they can raise money or not. If you're really impressed by the syndicate, it's like, wow, so they were, people that we know and respect quite well. They were able to bring these people on board, which is kind of challenging because a lot of times we're the lead investor and sometimes the only investor that's really an institutional investor. Um, but yeah, I mean, I think I focus mostly I mean, we think in terms of market team and tech. I mean, yeah, market team and tech. And market is everything from business model and techno-economics and, market adoption and yada, 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 SAM, TAM. Um, but the team is, in the tech, I think we do a really good job on understanding is there any physics risk, any science risk, as I talked about earlier, really understanding what are the engineering scale risks of this, physics risk and engineering risk can they're not easily separated. There's not a fine line sometimes. Um, but the team, it's like, is this person, are they going to be able to attract talent? Do they want to attract talent? Do they like to tell stories? Can they tell a story? Because a lot of that is very difficult to train into somebody. Does the person actually enjoy going to a room, into a conference where they know there are a bunch of potential investors? Do they actually get excited and look forward to working the room? Or do they actually find it absolutely horrific and terrifying?
So at TDK Ventures, and of course we play with the fact that TDK is known for the tape and the magnets, but we look for CEOs who are magnetic. People want to go and work for that person. But you just made me reflect on your first question, which is, can the CEO raise money? And you were talking earlier about loss ratio. So we've lost three portfolio companies out of 44 in the last 6 years. And the three is all about the CEO not managing to raise the next round.
Yeah.
And you could argue it's also about not winning the customers. So there's an element of winning customer, but that's a really good questions to ask. And I'm just realizing that our best ones, which are unicorns, are all about the CEO being exceptional, and you could tell they would be exceptional at raising financing. And the ones that didn't, you could see why they would struggle, but we thought that they would still be able to. So you make me reflect a lot today.
Well, good. Well, thank you. You helped me quite a bit as well. But also, it's not, I mean, raising the money, they raise them, but they also have to have a real love of organizational design as well. I mean, the people that are out there just raising money, their operations can go to hell in a handbag, if they don't actually able to right, and to do that, right, to bring in the kind of people to set up the organization, to attract the right people that can manage the organization when you're not there. That's a very special thing, and it's also one thing that's very hard for these CEOs to let go, right? For them to say, "I brought in a CTO, I need to let go and let that person actually be the CTO." Right. We have a lot of or not a lot. We have a few founders that we bring in the VP of engineering or the COO, and they put in the processes in place, the brilliant VP of engineering or COO. And then the CEO, the founder, is the one who's breaking all the processes and going around these processes, so they can't let go.
So maybe we'll touch on a touchy topic. How do you think about changing the CEO? Because at some point that might become obvious this is the best way for the project to succeed. How do you think about that?
Well, honestly, the best cases, we've had a number of cases like this, is the CEO's like, "I don't wanna do this job. We built the company to a certain point. I don't wanna be on the road talking to investors. I wanna be." And so there's like, "Okay, great." And they often become the best, recruiter for a new CEO. We go out and find a new CEO, but they're the ones who are really doing a spectacular job selling the business to the CEO.
So I think you're
Um
starting with the easiest and best example.
Yeah, yeah. The other ones though, and this is we're trying to get better at this. Honestly, I mean, just because, many of us have been CEOs and have built businesses, and have been moved out of the CEO role into some other role or moved up into the board or whatever. Um, it is to start with, to lay out the track, as I was saying, you're maybe 100% internal initially and a little bit token investors, and then eventually you get to the point where it's spending 70, 80% of your time externally. Well, you walk them through that journey. So how do you feel about that? How do you how do you feel about leaving the lab to basically build your HR? You're basically spending 10 to 15 hours a week just doing interviews. How do you feel about the fact that you're spending 10 hours a week, talking to investors? Is that what you want to do? And what are you going to be giving up in order to do that? And then are you good to be, you need to speak at 8 to 10 conferences a year. You need to basically be on the road for business development and customers, at least once a month. You need to be going to 6 to 8 investor conferences a year. So that could be, I'd sometimes spend, 40 to 60 nights a year on the road. Are you good with that? But you talk about that when they are just getting their first seed check and you lay out sort of the growth plan over the next 3 to 5 years. If and when you're wildly successful, you will be spending 40 to 60 hours on the road. Are you ready for, or are you good with that?
That's an interesting way of framing it. I like it. So yeah, I want to ask a final question, which is really about clean energy ventures. What are you excited about the next 18 months? There's a lot not to be excited about right now, but if we think about the future and something to get excited about.
Yeah, I mean, that's a good question. So there are a few things. One of them is I'm excited, but also concerned is, the US economy because of, Citizens United and how messed up our campaign finances. Neither party would put in enough regulations to actually have force companies decarbonize, but Europe is actually putting the sticks in place. In the US, we dangle carrots in front of people in the terms of incentives and subsidies. And the reality is to buy these into these lower carbon supply chains, and you have to convince your procurement person to do it. That's a lot of risk, right? And there's no penalty for not decarbonizing. There was some shareholder headwinds, but those don't exist any longer. There's some consumer headwinds for or pushback in certain cases. In the in But those are all carrots, and they're really not effective. And so if you look at the sort of the 4,500 companies that made, net zero's SBTi targets, they're not buying new technologies can risk their operations. They've got to be basically you've got to have a technology that has a under a 3-year payback, for even a CFO. We call it the
Mhm.
paradox of the 12. So the CEOs are measured every 12 weeks. They're compensated every 12 months. The reality is that the average tenure of a CFO and a CEO in corporate America is about 4 years, 5 years, and they're not gonna be making 10-year bets, right? In Europe, if they can get these regulations in place and with the right teeth and with very few exceptions, those are major sticks. I mean, they're saying you basically can't do business with their 600 million consumers that we have in this market. Um, so excited about that, concerned that it's gonna be watered down over time. Um, but oddly enough, I'm actually pretty excited about sort of the Trump administration. You can't use words like climate and decarb and yada, yada, yada. But if you look at what they're focused on, supply chain security. They're focused on advanced manufacturing, grid resilience, right? I mean, it's basically a lot of industrial carbon, and if you can offer a solution that's better, cheaper, and faster to deploy, the administration is behind it. Now you don't wanna get in the crosshairs of some of the industries that they hate, like, wind, particularly offshore wind. But there's a lot of stuff that they are actually supportive of. So we'll see how that
Absolutely. I
plays
think
out.
the overlap between a lot of the decarbonization solutions and energy resilience and avoiding imports of materials you could recycle locally or you don't need with new technology, the overlap is very serious.
It is, and it's pretty large. I mean, we were just mapping that. We're launching a growth fund, or we've launched a growth fund that we're, talking to people about right now. Yeah, I mean, most of our companies in Fund 1 map directly to the energy agenda, if you will, of the Trump administration.
Yeah, yeah. Well, Temple, it was a pleasure to have you on the podcast. Thank you so much.
Well, thank you. I really appreciate it. Take care.